Welcome to the Deep Dive, the show where we really try to cut through the noise of financial reports. Sometimes you look at these reports and they seem like just numbers, maybe some corporate jargon. But honestly, if you dig in, they tell a fascinating story of the company, its strategy, and even the wider economy. So today, that's exactly what we're doing, a deep dive into PNB Housing Finance Limited. We're looking at their first quarter for the fiscal year 2025-26, the period ending June 30, 2025, and we've got a lot to work with. The unaudited results, consolidated standalone, the press release, investor presentation, audit reports, regulatory filings, the whole package. Our mission, simple. Unpack it all, find the key insights, and help you understand what it means for this major player in India's housing finance space. Okay, so let's jump right in. What are the big headlines from PNB Housing Finance's Q1?
Well, the headline numbers certainly look pretty positive. PNB Housing Finance reported quite a jump in profit after tax for Q1. They hit INR 534 crore.
534 crore, okay.
Yeah, that's a solid 23% increase compared to the same time last year, Q1 FY25. Now, it's worth mentioning there was a slight dip, about 3% from the previous quarter, Q4 FY25, but the year-over-year trend is definitely strong.
That's a great jump year over year. How did that show up in their main business activities, like revenue and loan growth?
Right, well, total revenue from operations also saw healthy growth. It pushed past the INR 2,000 crore mark this quarter.
Well,
And on the asset side, their core lending business, the total loan asset, it expanded significantly. That's up 16% year over year. It's now getting close to INR 78,000 crore as of June 30th.
wow.
And their asset under management, the AUM, also grew nicely. That's up 13% year over year to over INR 82,000 crore. So yeah, it's clear they're growing not just profits, but the actual, size of their lending book too.
So more loans out the door, more revenue coming in, more profit. But for any lender, the big question is always, what about the quality of those loans? Is the growth sustainable?
Exactly. That's the crucial question. And what's fascinating here, I think, is that alongside that strong profit growth and the loan expansion, they've also shown improving asset quality.
Really?
Yeah. Their gross non-performing assets, the GNPA, it's basically the percentage of loans where borrowers are falling behind significantly.
The risky ones.
Exactly. That declined to a pretty healthy 1.06% in Q1. That's down from 1.35% a year ago.
That's quite a drop.
It is. And their net NPA, the NNPA, which is that same figure, but after they've set aside provisions for potential losses, that stood at just 0.69%. So this really signals a robust operational quarter. And it also maybe points to a healthier credit environment overall in housing finance right now.
That overview definitely paints a strong picture with those headline numbers. But digging a bit deeper, PNB Housing Finance has been quite vocal about where they're focusing. So, if you're trying to figure out where they're placing their bets, it seems pretty firmly in the individual home loan market, right?
Absolutely. The numbers really bear that out. It looks like a very deliberate strategic shift towards retail lending. Their retail loan asset grew by a strong 18% year over year. It's over INR 76,000 crore now.
Okay.
And that makes up a dominant 99% of their total loan asset.
99%.
Yeah. And compare that to their corporate loans, they're just a tiny fraction now. They actually saw a 56% reduction year over year. So yes, a very clear strategic move.
So PNB Housing Finance is really all in on retail. But even within retail, it seems like there are two specific areas that are like the real engines of growth: affordable housing and these emerging markets.
That's exactly where their strategy seems to be paying off the most. The affordable housing segment loan asset, it showed, frankly, exceptional growth. It more than doubled, up 143% year over year.
Wait, 143%?
Yes, reaching nearly INR 6,000 crore.
Wow.
And then the emerging markets segment loan asset, that grew by a strong 20% year over year. That's over INR 22,000 crore now. And if you connect this to the bigger picture, this focus on these higher yielding segments, it's clearly a strategic move. It directly impacts their profitability and maybe their risk profile too.
And how significant are these two segments now to the overall retail business?
Very significant. Combined, affordable and emerging markets now make up 37% of their total retail loan asset.
Okay, over a third.
Right. And they contributed a full 50% of all retail disbursements in Q1. Disbursements in these areas grew 30% and 32% respectively. So huge momentum.
And why did that matter so much? Is it just volume?
Well, volume helps, but it's also about profitability. The incremental yield in emerging markets, for instance, is about 35 to 40 basis points higher than in their prime segment.
So more profitable loans.
Exactly, more profitable loans. And it's worth noting they actually reclassified 20 branches back in April from prime to emerging markets to make comparisons clearer. That just underlines their focus here.
Okay, but even with that shift, their prime segment isn't vanishing. Still growing 10% year over year over INR 48,000 crore. That's still the biggest chunk.
True, still very significant.
And supporting all this, you've got a wide network, 356 branches, with a big presence in affordable 200 branches and emerging markets 80 branches, plus over 13,000 channel partners helping out. We've seen the impressive growth, the improving asset quality, but how efficiently are they actually turning this business into profit?
Yeah.
Let's talk net interest income, NII. That's sort of the core profit picture, right?
Right. NII, the difference between interest earned on loans and interest paid on borrowings, that grew by a healthy 17% year over year, hit INR 760 crore.
Right.
Their spread on loans improved too, up to 2.23% in Q1. That's up 12 basis points year over year. And their net interest margin, NIM, stood at 3.74%, up 9 basis points. But here's something crucial, I think. Their cost of borrowing actually decreased. It went down to 7.76% this quarter.
Oh, interesting. Down from where?
Down from 7.92% a year ago and 7.84% just last quarter. So there's a nice downward trend. And that really raises an important question, doesn't it? What does a falling cost of borrowing combined with widening spreads tell us about their financial health, their market position?
Yeah, that's a great question. It definitely suggests efficient liability management. Maybe they're locking in funds at better rates.
Could be.
And it also suggests strong demand for their loans, allowing them to keep those margins healthy.
Precisely.
And what about the overall profitability metrics? Return on assets, ROA, return on equity, ROE.
Also looking good. ROA, which kind of measures how well they use assets to make profit, was 2.57% annualized for Q1. That's up from 2.37% a year ago.
Okay.
And ROE, showing profit generated for shareholders, was 12.39% for the quarter.
So solid returns.
Yes, solid indicators of efficiency. But let's circle back to asset quality and risk management. It's just so critical for any lender.
Right.
We mentioned the improvement in gross and net NPA already, and it's really encouraging that their corporate GNPA stayed at 0.
Right.
Nil.
0 corporate bad loans. That's impressive.
It is. Their provisioning coverage ratio, the buffer for potential losses, was about 35.36%.
And you mentioned something earlier about recoveries from written-off loans. That sounds interesting from a risk perspective.
Yes, this is quite noteworthy. They recovered INR 57 crore from loans they had previously written off in Q1, and that figure actually includes INR 98 crore they got from selling properties linked to those written-off loans.
So what does that really signal? I mean, the fact they're getting that much back from loans already considered lost, that speaks volumes about their collection efforts, right?
It absolutely does. It highlights really effective collection strategies, a strong follow-up process, and beyond just recovery, their initial underwriting and delinquency control look quite disciplined, too. For instance, they've rolled out a business rule engine in their Roshni affordable housing segment.
Okay, what does that do?
It helps automate decisions, and they're using machine learning. Apparently, it's led to around 23% of eligible salaried loan applications going through straight-through processing, STP.
STP, meaning no human intervention needed.
Essentially, yes. For those eligible cases, it's pure automation. Think about the efficiency gain there.
Wow, that level of straight-through processing. That must be a huge efficiency boost, especially in a high-volume market like India.
It's massive, not just cost savings, but think about the speed, the customer experience, the ability to scale up, especially in those affordable segments we talked about.
Makes sense.
And it seems coupled with caution, too. 96% of their new loans were for ticket sizes up to INR 1 crore, and 85% of loans booked in Q1 had a credit bureau score over 700. So disciplined lending.
Right.
And their collection efficiency remained incredibly high, 99.2% in Q1.
And 99.2%. That's almost perfect payment discipline across their book.
It's exceptionally high. All these factors together feed into that healthier outlook on credit risk. Their total expected credit loss, or ECO provision, their estimate of future losses as a percentage of loans improved to 1.34% from 1.76% a year ago.
That's a strong picture on risk management.
Yes.
Okay, so what about the balance sheet itself? How solid is it? And their funding strategy?
Very solid, judging by the numbers. Their capital to risk asset ratio, CRAR, stood strong at nearly 30%, 29.68% to be exact, as of June 30th. And Tier I capital, the core equity, was almost 29%.
So that CRAR is like their financial cushion.
Exactly. It's their shock absorber. A high number like that means they are extremely well capitalized, ready for market bumps. It's a big green flag for stability.
And liquidity, ready cash.
Plenty. Their average daily liquidity coverage ratio, LCR, was maintained at a very healthy 229% for Q1. And their statutory liquidity ratio, SLR, was 15.5%, well above requirements.
Those liquidity numbers sound very comfortable. And how are they funding all this lending? Is their borrowing strategy diversified?
Looks quite diversified, yes. Around two-thirds, 66% of their borrowings are floating rate, which helps manage interest rate movements.
Okay.
And the mix includes sources like NHB refinance, bank term loans, external commercial borrowings or ECBs, customer deposits, NCDs, and commercial paper, a good spread.
A bit of everything.
Right. They also maintain strong security cover for their debt. Their secured NCDs have a coverage of 1.13 times.
And it seems transparency is important here, too. The reports specifically mention no deviation in how they used funds raised from equity or NCDs.
Yes, they're quite clear on that. The 400 crore NCDs they raised back in May, fully used for strengthening their long-term funding, for loan disbursements, and general corporate needs, just as stated.
Even the commercial paper proceeds were used properly.
That kind of clarity on fund use is really crucial for investor confidence. It suggests strong internal controls, good governance.
Definitely.
Which brings us nicely to their wider operational and strategic initiatives beyond just the pure financials.
Yeah.
How are these strategies feeding into the performance we're seeing?
That's a great connection. Because PNB Housing Finance isn't just relying on traditional methods. They clearly have a vision to be a major digital player. They talk about collaborating with fintechs, with banks, using platforms for more personalized products, making things easier for customers. And this isn't just talk, right? It seems to directly impact things like asset quality through better risk assessment and faster processing, especially in those high-growth areas we discussed.
Like the STP.
Exactly. Their strategy focuses on a frictionless customer journey, sales enablement, underwriting at scale, and using data for everything.
And what's underpinning that technologically?
Well, they mentioned embracing cloud, using lots of APIs for integration, strong security 24/7 monitoring, AI, ML, zero trust models, and automation too, DevSecOps, IT service management, RPA. It's clear they're investing heavily in tech.
Yeah, that kind of tech investment isn't just a nice-to-have anymore. It's fundamental, drives efficiency, gives them a competitive edge.
So it's really about transforming how loans are offered and managed for the future. And beyond tech, there's also a pretty comprehensive ESG framework. Environmental, social, governance. They actually rank quite well, top third in their industry in an S&P Global assessment, and rated medium risk on ESG by Morningstar Sustainalytics.
And this ESG approach, it looks like more than just ticking boxes. It seems embedded in how they operate.
It seems so. They mention practical things like easier KYC updates, CKYC integration, full sustainability reporting disclosures, mandatory POSH training for staff. And socially, they highlight things like a high percentage of women borrowers or co-borrowers, over 84%, and 22% women applicants in affordable housing, plus over 15% women in senior management.
That's quite specific.
Yeah, and other initiatives too, like mobile medical units for construction workers, biocomposting, supporting solar power projects.
So it sounds like a holistic approach. Trying to build sustainability into the core business, that can definitely drive long-term value, make them more resilient.
It really seems like they're looking at their impact much more broadly than just the profit and loss statement, building a more responsible business overall. So pulling this all together, what does it mean for you, the listener, the curious learner? When you step back from the individual numbers, what really stands out about PNB Housing Finance's Q1?
Well, I think when you look at these results, they're not just about one company's health, are they? They offer a really dynamic window into India's housing finance market as a whole, especially that explosive growth in affordable and emerging market segments. That tells a bigger story.
Right.
And it also really highlights how crucial robust digital infrastructure and transparent governance have become in finance. They aren't optional extras anymore. They're key drivers of success, influencing both profitability and risk management.
It's a fascinating glimpse into how a sort of traditional sector is rapidly evolving. So just to recap the key takeaways, PNB Housing Finance showed strong financial growth in Q1, a very clear and successful focus on those high-yielding retail segments, especially affordable housing. Asset quality improved nicely across the board. Their balance sheet looks solid, well-capitalized, good liquidity. And all this seems underpinned by a clear strategy involving significant digital transformation and ESG initiatives. It looks like they're positioning themselves for the long haul. So here's a final thought to leave you with. As PNB Housing Finance continues this deep dive into affordable and emerging markets, pushing boundaries there, what new innovations might we see next? Things that it could reshape not just how loans are offered, but maybe how homeownership itself becomes more accessible across India, especially in those growing Tier 2 and Tier 3 cities. Something to think about?